Hi, and welcome to another episode of The Pit, Personal Investment Tools and Techniques for the Individual Trader. Please note that this is not investment advice. I am not a financial advisor, and past performance is not necessarily indicative of future results. Today we're going to talk about sugar. Sugar has been making a tremendous move. Classical technical analysis has really pegged a lot of the turning points in sugar. Classical technical analysis is the analysis of a stock, future, or crypto price chart to determine the supply and demand zones, which may signal future price action. Then we can paper trade. We only recommend paper trading here, which try to minimize risk and maximize profits. Our goal is to find asymmetric trades that work out in our favor. An asymmetric trade is a lopsided risk-reward trade. You want it lopsided in your favor, meaning you're going to risk maybe $1 to make $2 or $3 or maybe $5. Here's the recent last 6 months of sugar action. These are daily bars in sugar going back to April. Sugar had a huge move up here. It's rallied over 20% in this move from the bottom marked as 4. This chart also shows several classical chart patterns which I think would have guided you well in trading. Let's talk about the first one. This is the 1-2-3 drives to a bottom pattern. This is similar to a 3 or a triple bottom, but you're having two successive lows, and you're making the first drive and then 2 additional quote-unquote drives to a bottom, and reverse would be drives to a top. These are distinct moves to a lower low or a higher high. This is right around the previous pivot low of May of 2024. It's not shown here. It's shown on the previous chart. Then also note that the low at 3 was what my father termed a spring. This is highlighted in his spring upthrust white paper at futurestruth.com. This is prices making a new low and then immediately not having any follow through and immediately rallying right back up in price. And then what we know after this spring is a well-defined trend line denoted by the green line sweeping down through the blue circle. We notice that the price action had a wide range break of that downtrend line. So this is a sign that probably higher prices are here. And that is exactly what happened. Once it broke this 1825 downward trend line, price rallied 10% to around $20, shown as in the middle of the graph at that high. And this trend line, I count it as a defined trend line because it's not just 2 touch points. I count 6 touch points for this trend line. Now let's move forward a little bit in time to this top. This was the initial rally off the low, and it rallied to 20 in late August. Again, I'm talking about the blue area in the blue circle. This has a 2-bar flip-flop at the very top. This is when prices rally up strongly one day, and then the very next day, our bar turned right around and show immediate supply coming in. A 2-bar flip-flop can be a temporary top. Here it is a strong up bar followed by an immediate strong down bar, which says further downside is likely. But I would note that the speed of the up move, the speed and the height of the up move predicts higher prices to come. So now we've got to look for a low risk entry level somewhere in the range of this prior up move. Here we move forward to the next circle bar, the low at 4. The next circle, blue circle at 4. From the highs of this move, prices pulled back to 4. This is a fib 62 level, meaning prices retrace 62% of the prior up move. That's one of the key levels where you look for support. The other major support zones are 38 and 50%. And note that this price action in the blue circle ended with a 4 close reversal. This is 1 bar reversing the immediately prior 4 bars closes. That happened, and you're breaking out of the blue circle at the number 5. Let's zoom out a little bit and show what happened. Prices rallied to over 23. This is a 25% up move in just 8 days. I would say that is a very dramatic move. That's the most dramatic move on this chart. So what's next? Here we've highlighted again the Fibonacci retracement levels of 38, 50, and 62% of this entire up move. Now I think, why do I draw it here? Because the ranges of the up moves are getting narrower. And then the last bar on this chart has a wide candle or wide wick on the top, meaning you found a lot of sellers here. And I'm going to talk more about that later. But I would be estimating at this strong up move, we'd be looking for a buy around the 38% retracement level or possibly higher. If we zoom out, we note that the current high that it made just broke the 2024 high back in the first quarter of this year. Also note that the bottom trend line in red, the 1-2-3 pattern, is formed right on that lower trend line. So this is another reason why the 1-2-3 drives to a bottom, formed a bottom, and you'd be looking for a low risk entry there, possibly on the spring at 3. Now let's zoom out even further. We note that the recent lows are the Fibonacci 62 level, which means they retrace 62% of the entire up move from the 2022 lows. And let's take this out one step further. We look at the fib retracement levels from the entire move from the lows in 2020 after the pandemic. We see of the entire move, we're at the fib 38% level, meaning 38% of that entire move up from 462 all the way up to 2659. Of note here is that the move from 2022 to the highs of 2023 is greater than the first wave of 2020 lows to the intermediate highs of 2021. This means you're finding more and more buyers coming into the market on that up move that we just had. So I'm predicting a 5th wave up to test those highs, or possibly maybe we get a whole new 5 waves up, which takes us an equal distance up to 40. Only time will tell. Leave your notes in the comment section. Let me know what you think we're going to. Thanks for viewing. Please like and subscribe if this content is helpful to you, and let me know how I can make this better. Have a good day.